I'm Bill Auten of Auten Claims Management.
I'm Chantal Roberts of CMR Consulting, and welcome to the Art of Adjusting podcast.
Today, we're going to talk about life as an insurance adjuster from the perspective of property, auto, liability, or workers' compensation adjusters. Our goal is to bring interesting topics in the world of claims adjusting to people who are working as an adjuster now and to people who are considering a career as a claims adjuster. Hey, Chantal, how are you?
Doing well, thanks. How are you?
We're just fired up today, aren't we?
We are, as always, because we're going to be talking about ACV, depreciation, depreciation on labor, depreciation on taxes, overhead and profit,
Yep.
and can we do it? Can we not do it? You and I are polar opposites. So everybody tune into YouTube, because this is where you're going to see us fist fight. It won't come across well if you're listening to the podcast.
Well, I don't think we're going to get into a fist fight, but anyway.
Yeah.
So the root of this was a class action lawsuit, and I don't even remember where it is. Do you know offhand?
I do. I have a couple of articles. Okay, so the one that I knew, of course, occurred in Arkansas, and at least maybe I think like the Western Federal Division of Arkansas or whatever.
Okay.
There is one that I have pulled up here from the Insurance Journal, and this one happens to be kind of old-ish. I mean, it's from February 2023, so I don't know what the update is, but it is also talking about a class action lawsuit in regards to how the insurer handled actual cash value. And
Yes.
even the one in Arkansas, it all revolves around the depreciation of labor. If you take, well, I think maybe we should start off again, as always, as we always do, starting off with a definition. And as you and I were talking about before, like if you look at the standardized, non-endorsed homeowners, CP, commercial property policy, whatever, there's not a definition of actual cash value. So we as adjusters tend to look at, of course, what the average or what the everyday use of the word is. And I think the down and dirty version is replacement cost less depreciation equals actual cash value, or ACV.
Yeah, I think that's the widely accepted version, and
Mhm.
I can look in my legal dictionary over there to see what it actually says, but I believe it's something along those lines. The devil's in the details, because what is depreciation? That's the real question.
Right.
It's very simple to say RCV minus depreciation equals ACV, but what is depreciation then? And that's a reduction in value because of age or obsolescence or condition,
Wear and tear.
wear and tear, some other
Yeah.
thing that reduces its value. And so how do you quantify that? And there's multiple ways to do that.
Right.
Um,
There
well,
are a couple of other things, and I don't know if you were going to get into them, like fair market value.
mhm.
Yeah, I didn't know if you were going to be talking about like necessarily that thing or whatever. Which, uh, yeah, there you go. I'm going to open it up to you, Bill. I'm just
Okay.
going to throw you in front of the bus.
Well, in New York and several other states, there is more than one way to skin a cat.
Hey,
And
hey, my cat is over here. He's wanting to get involved. He's sitting over here just purring away.
well, good thing he
He
doesn't
wears his
understand
tail.
English. Um,
Oh, but he does. See, he's just come back up. He's like looking at you.
oh boy,
Yeah,
look
you're
at
gonna die.
that. Well,
Okay,
Kitty,
I'm
there's
sorry.
more than one way to skin you. And the reality is that when we look at depreciation, um, we can calculate that in terms of age. So if the paint on your wall, let's say that we think paint lasts 10 years, and after 10 years, it's pretty much worthless and you have to replace the paint after 10 years.
Mhm.
So that's a really subjective comment. I don't know how much truth there is to it. It depends, I guess, a lot on the condition of the paint. But let's say that a group of scientists get together and they say that on average, your average latex wall paint after 10 years is functionally obsolete, meaning it does not perform the job that it was designed to do anymore. Okay. Um, this is argument's sake here. This is not Bill's
Correct.
opinion on latex paint, by the way. If they were to do that and you have a claim where the walls need to be repainted, you could say, well, that paint we've established is 5 years old. Therefore, 50% of its life has passed. Therefore, we're going to depreciate that by 50%. Okay, so that is one approach. And I'm not saying it's the correct approach, and I'm not saying that it should be adhered to all of the time. I've worked for carriers that say you use age-based depreciation only. And the reason they do that more than anything is just to say, here's the standards that we use. We use it across all of our claims. And if you think those standards are wrong, we're willing to talk about it, but this is where we come from. Oh,
Right.
okay. And most carriers on the property side, I may be speaking out of turn here, but I think most carriers on the property side are willing to negotiate when it comes to depreciation. Okay. So these are not steadfast rules.
Yeah, I
But
think it's really open for interpretation.
sure, and that brings me to my next method of depreciation is basically just an adjuster's opinion, where you look at it and you say, well, how bad is it? Is it 10% depreciated, or 30%, or 50%, or 90%? How bad is it? If you're on a roof and the shingles are sliding off the roof, but there was clearly damage to it that's covered, like maybe a fire, I don't know. But you can tell that the roof was really, really old. You would, and you don't know how old it is. You don't know the age. So if it's a 30-year shingle and you have no idea when it was installed, you have to take a best guess as to how much to depreciate that. So you use a judgment. And that's where hopefully you can get reasonable minds to agree on what the depreciation is. And of course, you'll run into scenarios where the adjuster thinks it's 30% depreciation and the insured thinks it's 0% depreciation, that they're entitled to the full amount of the value, because in their mind, it shouldn't be depreciated at all. But
May I interrupt real quick?
yes,
What I would recommend while we're talking about a disagreement between maybe the insured or the policyholder and the adjuster is the adjuster should have or ask that the insured's contractor of choice be present at the time of inspection, because that is going to save a lot of headaches down the road, so that both of you are up on the roof at the same time and y'all are both looking at this going like, okay, so I think it's 30% depreciation, and the contractor goes, absolutely not, at best it's 5%, I put this up last year or whatever. So that way it does save a lot of back and forth, and that's what you're ultimately listening to us talk about, is how can we make your jobs easier? This is a way to make your job easier. And of course, not all policyholders are going to know who to hire right away. That's fine. And you're going to get called back out for a supplement or whatever, but that's what we're trying to avoid. Let's just
sure.
get agreed, like you said, a coming of the minds, an agreement of the minds.
Yeah. And it may be that you can't.
Right.
And honestly, I don't see the roof as a place to have conversations about depreciation as much as scope. I want to verify, if shingles are damaged by a covered cause of loss while I'm up there.
Mhm.
We can do depreciation discussions and talk based on what we saw up there later, and based on photographs and based on information about when the roof was installed, which we can get presumably from the policyholder or maybe even that roofer,
Yeah.
like you had said. Um, but you know, I also don't think that on the roof is where you negotiate. I
No, no,
think
no,
that
you know what I mean. That's
yeah,
not,
yeah,
I'm not saying you and the roofer are gonna be up on the thing. And if y'all don't agree, you get to push the roofer off. That is not what I'm saying. You do not, no. I'm just saying both of you are there at the same time, because if you can both come to an agreement of scope or an agreement of price or whatever, it is going to save you as an adjuster time down the road, because hopefully you will not have a supplement.
yeah. Well, and supplements are something that happens, and a supplement is not the end of the world. And any claims manager who thinks that a supplement is a terrible
Okay?
thing,
I'm not
I
saying it
don't,
is.
I
I'm not
I
saying
don't,
it is. I'm just saying it it keeps you from having to keep on going out there. I mean, you can close your claim faster. The insured can get paid faster
sure,
because
sure,
everybody is agreeing, rather than, okay, I think that it's 30%. I'm going to pay you off of that. You think it's zero. And then we're going to come somewhere in between, and then I'm going to have to write a second check or whatever. It would be better if
yeah.
I could just close that file. That's all I'm saying, Bill. I'm just saying, be
Wait, hey,
cooperative,
this isn't
darn
even the
it.
thing we're supposed to fight about.
I know. I'm just trying to say be cooperative, darn it. Okay, go ahead. I interrupted.
So anyway, let's see. So I covered age-based depreciation. I covered adjuster's judgment.
Right.
Another thing you could look at is market value, fair market value.
Hmm.
Um, that's kind of tough to do on a roof, but if you have a total loss to a house, well, then that fair market value is a pretty good judge of actual cash value. It's
Absolutely.
important to understand it, understanding how depreciation is calculated or fixed. Hold on, my screen is. Oh, there we are. The moral of the story: the old woman who lived in the shoe. Co-insurance, it says.
Yes, but I was talking about co-insurance in this particular thing, as I interrupted you again and distracted you, in this particular nursery rhyme. But I also talk about ACV on property, and
Okay.
how to determine it, because of course, that sometimes plays into your co-insurance. So yeah, like all the way over here, I'm talking about ACV. And of course, this is for and I'm showing this because this is our topic. Um, this is for consumers. Uh,
Yes.
and so market,
This is your new book, correct?
yes, yeah,
All right.
yeah.
And what's the name of that book, Chantel?
Oh, well, let me show you, Bill. It
Please.
is Once Upon a Claim. Hold on, I'm trying
Once upon a
not to
claim.
fairy tales to protect your assets.
Look at that.
Isn't it
I can't
cute?
wait to get my copy.
Yes.
It's available in May, right?
It is available in May. You
All
can
right.
pre-order. And also right now, and I have no idea when this is going to be. Okay, we're yes, you could sign up right now on Goodreads to
Yes, to get a free
possibly
copy. I
win
saw that.
a free signed copy. So,
Yes.
just
So everybody
just
go
saying.
to Goodreads and sign up for a free copy. I saw
Yes.
there was like 600 people signed up already.
Yeah, super excited. Okay,
Yeah.
anywho,
Yeah.
okay, so we've got three ways to determine ACV. You've talked about the market value, you've talked about the broad evidence rule, which is basically, kind of like what everybody else would pay for. What is the price across the area? And then we've talked about the mathematical formula, which is the
Yeah.
down and dirty fast rule, so
Right.
to speak.
Right.
Yeah.
Um, and there are more than just three or four
Oh,
methods
yeah.
of determining actual cash value. And uh, I've seen fair rental value
Hmm.
proposed. I've seen the policy limit itself used as a metric um, as to the value of a property.
We get into that, and I was just talking about that with my students, my RMI students, because, I was talking about what is indemnity.
Mhm.
Indemnity is that big old fancy insurance word for payment. And I said, so the theory behind insurance is that we are going to put you in the spot where you were before the loss. That is the theory. You are not to make a profit from insurance.
Right.
And I said, is this technically true? And they're like, oh yeah, no, yeah, blah, blah, blah. And I said, well, what about replacement cost? Because if I have a 5-year-old TV and it gets hit by lightning, and I have replacement cost on my contents, I can go buy a brand new 2024 TV. And
Right.
that's an improvement. I've profited, quote unquote, for those of you who are, listening rather than watching me do the air quotes. Um, but we call that betterment in insurance.
Right.
We call that betterment. And you sometimes see betterment in auto claims more than anything. Uh, but yeah,
Yeah, and contents claims too. You run into, like, the TV is a great example because technology is changing so fast that you can get an amazing television today for $250 that would have cost you $1,500
yes.
10 or
Mhm.
15 years ago.
Yeah.
Um, so the
So,
bottom line with the broad evidence rule isn't that there is a cataloged list that you have to look at every time you have a claim or a total loss claim or even a partial loss. The idea between the idea of the broad evidence rule is that you use all available resources to find out what the actual cash value is.
mhm,
And a lot of times what that means is this isn't necessarily the right way to do it, but it's not the wrong way to do it either,
right.
is to take all of those methods
Mhm.
and mash them together and come up with an average.
Right. I think
And
that's a really good explanation of it.
yeah, and maybe you need to weight it one way or the other based on certain circumstances. For example, let's say that the market value shows that a property is worth $250,000,
Mhm,
and the limit, let's say for this argument, is the policy limit was an actual cash value policy only, and they set the limit at $150,000. Well, those are two things you can use. However, let's say that actual cash value limit was put in place 15 or 20 years ago. Well, that means you're going to give more weight to the newer market value number than the older ACV number that was uh, chosen when the policy was written 10 or 15 years ago. Anyway, silly example probably, but
no, no, no,
that
no. I
that
think
kind of
that's,
demonstrates, how the weighting of these averages might work.
yeah. Okay, so one of the other things, since we are also talking about depreciation, one of the other things that I want to urge adjusters not to do, because so many of us do work it off of a mathematical formula, like it's a 30-year shingle. It's been used for 15 years. I'm going to knock off 50%, or it's been used for 20 years. I'm going to knock off 75% or whatever that mathematical formula would be, or that percentage. If the insured has replacement cost coverage, I would really encourage you not to go over 50% because you, A, are going to get into a fight. And then B, even though the insured would, and this, again, this is my personal opinion, but I'm just trying to help adjusters handle their claims quicker, faster, and more efficiently. If you take 75% of the RCV for that shingles, that roof, whatever, that doesn't leave the insured, because you also have to take the deductible. It doesn't leave the insured with a lot of money to pay for the materials and the roofer to put up the roof. And they may be living paycheck to paycheck. They may not be able to get a loan to fix their roof, whatever. So in that particular instance, go to your supervisor and say, hey, we really need to bump this back, even though they will get another check for the remainder, the holdback depreciation when they fix the roof. I'm just saying, don't don't be a jerk. I
Yeah,
guess.
and comply with your company's
Absolutely.
policies and standards. And if you don't know what they are, check it out. Ask your supervisor. There may already be standards in place about the maximum amount of depreciation they will apply. That's a
Hmm.
business decision that every carrier will make. Some carriers may not use any kind of threshold, and they may say, if, and I've worked for them, where they'll say, if it's 10 years old and it's got a lifespan of 10 years old, there's virtually no ACV left. um tough position to take, but I think using the 50% is probably an agreeable way to go about it, a way that will avoid a lot of lawsuits against the company.
Yeah.
Um,
Yeah.
so
Okay. So we were
so
talking.
I'm referencing, I've been scrambling while we're talking here
Oh,
to pull
goody.
up the one blog post I have. This is dated, what is this dated? January last year.
Mhm.
So, various methods of calculating depreciation on third-party liability claims is the
Okay.
focus of that blog post. But it's replacement cost less depreciation. We talked about age-based depreciation.
Which is kind of the same thing, I think.
Well, not really, because replacement cost less depreciation doesn't really define depreciation. That is just the definition of actual cash value.
Yeah, but
But
depreciation is based off of your age of
not always.
the thing.
Not
Well, okay, so
always.
well, yes, we just talked about the broad market value and the fair market value, but by God, Bill. w-
Well, if you have a 2-year-old carpet that has been beaten to death by a couple of dogs, but it's only 2 years, that you're going to depreciate that a lot heavier, and that has
Yes,
nothing to do with its age. Or if you have a car that has been, that hit every bush in in the yard
my
as you
stepson
try,
has been driving
yeah,
it.
and beaten up by shopping carts in the mall, that's going to be depreciated a lot more, even if it's only a year old. So, to say that age is a determinant factor of depreciation isn't always true. So that's what the next one is: wear and tear. And those are
Okay.
the examples that I just gave. Obsolescence, that's another one that the TV example comes in there, where you, a computer is a great example of this,
Computers are
because
wonderful examples.
because
Yeah.
they lose their value so fast because they become obsolete.
Yeah, they're
Um,
almost like cars. I mean, as soon as you take them out of the Apple store, I mean,
mhm.
Apple has already turned over like two new versions.
Yeah. Here, I'll say some words, and you tell me if you think that these trigger the obsolescence thought in your mind. So,
Okay.
8-track tapes,
Yeah.
vinyl records, um,
No.
Blu-ray. How about
Yes.
even CDs? So all these things are
Uh,
outdated technology for the most part,
yes.
and
Although
if
I've heard the Gen Z is like, oh my God, CDs are cool. But of
yeah,
course, they're really into vinyl. But so vinyl, I would say no. But yeah, anyway.
yeah, it has a different reason for the value now. It's more of
Exactly.
a aesthetic kind of a thing,
Right. It's more of a
um,
vibe, man.
vibe,
It's a
nostalgia.
vibe.
Yeah.
Okay. Anyway,
So
but yes.
that's the big, or those are kind of some of the big bullet points on how to calculate depreciation. Um,
Now you were talking about liability, third party liability, ACV.
right. And that's
Okay.
important because in the context of this class action lawsuit that you brought up earlier,
Mm.
the one of the main arguments is that depreciation and actual cash value is not defined in the policy. And it doesn't say that you're allowed to depreciate labor in that policy. Therefore, you shouldn't be able to depreciate labor in that policy.
Right.
And to me, that's a silly argument, because you could argue that it doesn't say anything about depreciating materials in there either.
Hmm.
And if you're using the argument for labor, you should be able to use the same argument for materials then. So I think they cancel each other out there. There are other arguments against using against depreciating labor, and some of it is, well, that's that's somebody's time. That's not a material thing that gets older or wears out with time.
Mhm.
And that's probably the main argument. And I think those are the two pillars that the um, argument is made off of in that class action suit. There may be others. Correct me if I'm wrong, but I think those are the main points. And as I said, I disagree with the fact that it's not defined in the policy, because actual cash value is a legal concept and term. It's not a it doesn't necessarily where it doesn't have a definition. You've got to go to the common meaning of it in the
Right,
so
right. I totally agree.
so
I think we can agree on ACV, but these lawsuits that I've been hearing about are all first party.
yes,
And
that's where I was getting to.
so when we're talking third party, I think we have a different standard of care. Granted, we as the carrier still have the standard of care of being a fiduciary duty to our insured and taking care of the policyholder by paying the claims that he becomes legally liable for. Okay, great. So we don't want to mess around and deliberately lowball the claimant because we can, or whatever, because that is not taking the fiduciary duty of protecting our insured, because then they're going to get sued, right? Just because we're messing about. However, uh, I don't think the third party claimant is entitled to replacement cost coverage.
They're not.
Right. Okay. So then I'm confused as to what we're talking about. When it comes to third party liability ACV,
Well,
because I'm
in my
just,
mind, the way you calculate ACV on a third party claim
uh,
is the same way you should do it on a first party claim.
I
And the
see.
reason
Okay.
you should do that is because ACV and
ACV.
depreciation is not defined in the policy. It is a legal concept about indemnification.
Mhm.
So that is in fact, the article that you posted uses the word indemnity right
Okay,
in
so
the
yay. That's not mine. That is an attorney.
yes, you
Yeah.
cited the one you cited here. And I
No,
may
I
as
just
well,
sent it to you so that we could have talking material.
yeah. So
Yeah.
but it's a good discussion
Yeah, oh,
about
no, yeah.
the concept. I think this one is actually about broad evidence.
Yeah.
Um, so that being said, I I don't, these folks that are pushing the you can't depreciate labor argument on the first party side, I will bet you that they've never really made that argument on the third party side. Maybe they did, I don't know, but it's not a discussion we have, especially in New York, because
Well, I guess that's the thing, though, is that I don't depreciate labor. I don't depreciate sales tax. I don't depreciate overhead and profit when I have a third party claimant. So
why?
why would I
See,
treat my insured any
see,
worse? Why would I treat my insured worse? Unless, and there are some policies that have begun to say this just because of these lawsuits, these class action lawsuits, which states very explicitly, we will depreciate overhead and profit and sales tax and, labor and blah, blah, blah. And do, I,
I know you're from the church that doesn't want to depreciate those items, but I can tell you that that's a fairly common practice. If you look at the 50 states, the
mm,
decisions are all over the place on
they
it.
are, they are.
In New York, you absolutely can apply depreciation to those items,
Mhm.
and and the, and frankly, I agree with it, because I think it is. We've had this discussion before about manufactured items. I think I've brought up the argument about a whole house. If a whole house burns down,
Right.
and here in New York, we're going to use the broad evidence rule to figure out how much that house is worth. And nowhere in that discussion do we say, well, there's a market value that the appraisers came up with, or we hired a real estate appraiser to give us a market value. and they don't back out the labor on their calculations. They don't say we're going to separate all the materials here and we're going to figure out what the value of the home based on materials is, and then we're going to add back in the full cost of labor. That's not how they do it. And in fact, most of these, the strict market value, the obsolescence argument, the wear and tear argument, the age, well, the only one in here is maybe the age-based depreciation, because you're actually applying a number to it.
Mm.
In wear and tear, obsolescence, and strict market value, you're not taking the replacement cost and then figuring out how much to take off of that and then subtracting it. What you're doing is you're looking out into the world to find out what that market value is. So a car, brand new car, you drive it, we all know you drive it off the lot, it depreciates. So let's say it's a year old. You don't look at the replacement cost value of the car and then say, well, our calculations show we need to subtract $25,000 from the RCV of this car. That's not what you do. You go out and you look at what the market says that a 1-year-old car like that sells for. And the difference isn't the difference happens to be the depreciation, but you're approaching it from the market value, not a depreciation standpoint. And when you do that, you're not taking into account any of the labor to put that car together. And that's
You
my
don't
argument.
have to, because that car is already put together.
Well,
Plus the
so
fact,
is a house.
no, because the house has been burned down and we have to rebuild the house. But the car, if the car is totaled, and so we're looking at a fair market. So we're looking at our 3 spec cars, right?
Mhm.
You know, similar year, similar, age, similar mileage, whatever, similar features. Technically, that claimant or injured could take cash and walk into that dealership and say, I want to buy this car for $25,000, because that is what the market holds. And, that's what they're doing. Now, the problem is with that particular example, yeah, we're not saying any kind of labor or depreciating labor, because there's that car's already built. It's not like we can
But
drop a house right there where our insurance house is burned down, because that's
I
what
would
you're
like
talking
you, I would like you to talk to the UAW
about.
and tell them that there's no labor associated with the production of a car.
I'm not saying that there isn't. I'm saying
Okay.
that labor is already there. So
Yeah.
I'm not gonna back it out. That would be silly. That car is already there.
Well, so is a house.
Right. But you said the house burned down. So now I've got to build a house.
Well,
It's not like I can pop a house down. It's not like it's Wizard of Oz and I can pop a house down on something.
no, it has to be built, but a car has to be built too.
Uh,
Whether you buy the car already built on a lot or whether it's somewhere in a factory being prepared, it makes no difference. There's still labor applied to that.
yes, but I think we're using 2 separate things,
I don't think
because
so.
yeah, I do. Because what I was going to say is, moving on to this, using your car example, um, what we're supposed to owe for the replacement of the car, because the car is a total loss. So we're buying them a brand, or quote unquote brand new car, um, like kind and quality car. Um, what if we were to follow your rules? I guess we would look at how much labor the UAW put into it, and back that out based
If
off
it,
of.
if you were a proponent of not depreciating labor, but I am. See, you have to understand, you have to put yourselves in my shoes. I disagree with you. I think labor should be depreciated.
No, because the labor,
No,
anyway,
no, no, no.
here's
There's
the
no
here,
no. I do think that. You can't say no, you don't.
no, because I don't think we should depreciate labor.
I
Plus, okay,
understand you don't.
let me go on to the whole other thing, is because we also owe that claimant or insured tags, title, and license, right? We could equate that in property to overhead and, fees and, all of that kind of stuff, right? Which these insurers are saying that they can depreciate.
So
We
overhead
don't
and profit is different
depreciate.
than fees. So I
We
don't.
don't we don't depreciate tax title and taxes.
Yeah, but there's not a parallel between those items and overhead and profit. There is maybe for fees or building permits or things like that, but not overhead and profit. That's a different animal. That
Okay,
is a
so
business.
with the car, if we're not depreciating sales tax and titling and all of that, but we are on a house,
Well, sales tax is uh, sales tax is another conversation.
why am I treating my insured worse than I am my claimant? If the policy doesn't say so.
Yeah. Well, um, all right. There's a couple of different things. I think we need to stick to. We can have a separate discussion about overhead and overhead profit and sales tax and whether or not those should be depreciated. That's I think a separate argument. But on the labor argument, on depreciating labor, you are not a proponent of not depreciating labor on a car, correct?
I don't think we should depreciate labor, period, either on a car or on a house.
Okay, so on a car, um, how are you avoiding depreciating labor?
How do you depreciate labor on a car?
You
Okay,
don't.
are
That's
we
what
talking
I'm
about a
saying.
total loss or repair?
You
Well, either
well,
or, I guess. But
let's talk about total loss.
okay, total loss. The price I'm going to pay the claimant, are we talking third party claimant? Because we were talking third
Sure,
party claimant liability.
sure.
But I can talk first party. Well, I think it's the same personally. Okay, the insured has a 2009, or the claimant, excuse me, the third party claimant has a 2019 Mini Cooper,
Okay,
right? It is worth $15,000, right?
okay,
Okay. 2020 comes in with 40,000 miles or whatever at $17,000. A 2018 comes in with 30,000 miles at 17,500 or whatever. We're all getting about 17,000. So the price that I would pay is what, that 17 or 15 or whatever the car was worth as a total loss, right?
okay. Because you've looked at other comparable vehicles,
Right.
came up
Yeah.
with a value.
And that's the value of that vehicle,
Right.
right?
And that's what I said before. You're not looking at what a new Mini Cooper
Right,
costs
no,
and
not a
subtracting a certain
2024
amount of
or 2025.
depreciation.
No,
Yeah.
I'm looking at what that car is worth. That is kind of what we would consider to be the fair market value or the evidence or whatever we want to. Yeah. Okay.
Right. Right.
So I'd give the claimant $15,000 because that's maybe 16 because that's what that car is worth.
Right.
Okay. I'd also give them tax title license because they have to get that information, or they have to get that all as well.
Okay.
I don't knock anything off because that claimant should be able to walk into the Mini Cooper dealership and go, here's my $16,500, which includes tax title and license. Check. I'm going to sign it over to you. I want that car right over there.
Okay. And by
There's no
virtue of,
depreciation, no nothing, because all of that labor is already there.
wait a minute, wait. There's no depreciation. There absolutely is depreciation. It's the difference between what the new car is and what the market value of a used car is.
No, because I gave them a 2005 or a 2019 Mini Cooper. That's what we've agreed on is the price. So I'm
Okay.
giving them money for a 2019 Mini Cooper with 40,000 miles on it, $16,000 plus tax, title, and license. So it'll come out to 16,500.
Okay.
All right. Here's your check, Mr. Claimant.
Okay.
Boom. Then the claimant goes to the dealership. Now, if they want to buy a 2025 Mini Cooper, They are paying the depreciation or the difference or whatever.
That's the depreciation I'm talking about, though.
I don't
So
pay it
you,
though,
no, I know you don't pay it. You're not supposed to.
because I'm
Um,
supposed to put them back in the place where they were before.
right, right.
Okay,
Unless they
so
had a magical replacement cost policy in a car.
which like
Who
Liberty
writes that?
Mutual does offer to their
Okay.
insureds.
Okay. So what you've demonstrated now is the difference between replacement cost and actual cash value. That difference,
Mhm.
and you're thinking replacement cost is getting another 2019 Mini Cooper.
No, that's your actual cash value.
Okay, so replacement cost is getting a 2025 Mini Cooper,
Yes.
a
Yeah.
brand spanking new one.
Brand spanking new one.
Right.
0 miles on it.
Okay, we're following each other.
Right.
Now, how do you make sure, as a proponent of someone, as someone who does not feel that labor should be depreciated, how do you account for that in the scenario you have just described, knowing that the manufacturer did expend both labor and materials to put that car together?
I guess I don't understand your question because we're talking about apples and oranges.
No, we're not. How did the car get put together?
Well, yes, there's going to be labor. I'm not denying that. But
Okay,
I am not deducting that.
I know.
I'm paying ACV. I am not deducting any money for sales tax and license and title.
Right. That's
I
fine.
am paying him for what he had.
Let me stair step this a little bit. Let's do
The
an
issue is
exercise.
property damage.
Well, let's do an exercise, if you would.
Okay,
So your Mini Cooper, let's say your Mini Cooper tows a camper.
okay,
The camper is, let's say it's a 10-year-old camper,
yep,
and it gets totaled as well.
okay,
Now, my guess is you're going to treat that just like you did the Mini Cooper. You're going to find market value somewhere of the same camper,
mhm,
and pay them based on the actual cash value of that 10-year-old camper.
yes,
Correct?
yes,
All right. Now, let's say that Mini Cooper is towing a much larger travel trailer.
mhm.
Same rules apply or different rules apply?
Same rules apply.
All right.
And you know
What?
why,
Why?
right? It's because I can drop a brand new, or when I say brand new, quote unquote, new to them travel trailer,
Okay.
but it's going to be based off of the market value or whatever. So if it was a 2020 travel trailer, I can drop a 2020 travel trailer in there and I am not going to take any depreciations. The
Okay.
issue is if,
Depreciation on labor, you mean? Just
yeah,
to be
the
clear.
depreciation on labor or sales
Right.
tax, which insurers are wanting to do, you
Okay.
know, even on houses. The thing is that I can't drop a brand new kitchen that has been destroyed by fire into a house or a brand new house that has been completely torn off its slab because of a tornado.
So I was going to go next to a mobile home,
Right? Okay.
but I think we got the idea. Let's jump right to a manufactured home
Same
where,
thing.
okay, same as what though? Same as a travel
Same as a
trailer?
mobile home. That's
Okay.
what they're called.
Okay. What about a prefab home
Okay, a
that's
prefab home,
lifted
like
in
it comes
place?
from,
A
but
factory.
like the
Yep.
whole wall comes in and all that kind of stuff.
The roof's all made, pop it on top and
Right,
attach it and call it a day.
right. Okay, you still have to have labor to put that thing together, right? I mean,
Hmm.
just because some of the labor is put into the cost of making it in, let's say, Padula, Kentucky or whatever, and then shipped to Little Rock, Arkansas, you still have to have construction guys in Little Rock, Arkansas to hoist that thing up, hold it while Bubba is using his nail gun or screw or whatever to join. So I'm not going to depreciate that labor.
So I think you're being unfair to manufactured workers here. Um,
Why?
Because you're assuming that just because people who build things have to be on a work site,
No, I'm not.
that
They have put their labor in their price.
well, so does a car manufacturer. So
So,
does it.
okay, yeah. Okay, so the prefab wall,
Yeah.
right? It cost $1,000.
Well, it
Let,
materials or labor or both.
I can break it out for you if
Well,
you want.
I,
I mean, but yeah,
you
so
said it
it's
costs, but
gonna cost $1,000. So
okay,
we're gonna do 500 for materials, 250 for labor, and then 100 for the back office, and then what am I up to? Like 7 or 750, and then 850, and then I don't know, another 150 or whatever for profit.
okay,
Boom, 1,000. So I have put labor into that,
right,
but it doesn't come out like it does when we as adjusters are looking at it on the Exactimate, where it says labor 15 cents or whatever it says, or on that very like second to last page or last page where it breaks out all the materials and then all the labor to it and da 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 da, blah blah blah,
okay,
to say labor is $1,000 and we're going to depreciate it by 15% or whatever. No, I'm not doing that. What I'm saying is that wall that comes in, that manufactured wall, the prefab wall, already has its labor in it in the sales price. And
okay.
you're
So
right. You are right. A car also has their labor in the sales price. I'm not arguing that. I also don't appreciate that
you're
when,
not. Well, you're
because
gonna.
I'm giving them ACV. Um, but the difference is I can drop a car right in the middle of something. I can't drop a house. So here's the
Okay,
deal. What we need to be looking at is, what does the insured have to pay when the insured is having to fix this? Because remember, we are paying, as the insurance company, we are indemnifying, paying the insured for what they have lost, right? They have
yes,
suffered a loss of fire to their kitchen. So we are replacing the kitchen. That's what we're paying for. That's what they paid their premiums for. They, the insured, still must pay upfront all of the labor, 100% of the labor, 100% of the sales tax, 100% of the licensing. I say it is not fair for me, who is sitting on $100 billion, to take out 15% because the kitchen is 15 years old out of 30 years old or whatever.
sure.
I have no idea, but I don't think that's fair. Even if the insured gets it back because the insured gets replacement cost, even if the insured has ACV on their building, I don't think that's fair, which is why I don't depreciate that. And I don't think we, as the insurance industry, should, because our job is to put the insured back to where they were as best as we can. And if they had a 15-year-old kitchen, we're going to pay for a 15-year-old kitchen. Taking 50% depreciation off of labor when we know that they have to pay 100% of that, I mean, come on. Materials, sure, I get it. Materials rot, they bang up. I got nicks all over my paint job in the kitchen and stuff. And I've only been living here 5 years, but I would be hot under the collar if my
So
insurance company.
when I do prepare Xactimate estimates, there are certain labor only items
Right,
that I will not depreciate.
right,
So that might mean cleanup, um, might even mean masking and taping, any remediation activities. You don't depreciate that. That is
right,
strictly labor. That's only labor.
right,
Um, but when it comes to a component like the like a roof,
Yeah.
because it's a system and,
Or paint, thing.
and paint.
Mhm.
On those items, we do apply depreciation, but we don't separate out labor and materials. We just
You
don't
were
do it
talking
here.
about the line of an Xactimate, which says, painting a room, which does incorporate, if you were to like click on it, it does incorporate like masking and taping and covering, right? Is that what you're talking about?
No,
Oh,
like there's a setting in Xactimate where you can ask it, or it'll ask you, do you want to depreciate labor and materials? Do you
right,
want to
right, right,
depreciate overhead and profit?
right,
Do
right.
you want to depreciate sales tax?
Mhm.
They give you that option, and it's not because there's some nefarious evil organization that is purchased by evil insurance companies. It's because every state is different, and reasonable people disagree about whether or not this is the right way to approach these things.
Right, because you and I
Um,
disagree on it, so.
yeah, but um, but what I'm saying is that when there is an absolute labor only item,
Right,
that we don't depreciate that. But when there is a component or system that gets built or painted or whatever, and the end result is, um, like I said, an installed roof,
mhm,
we don't, we generally, and you may disagree with this, but we don't separate out the roofer's time and labor to put that roof on uh, versus materials. We look at the whole roof as a system, and we say that's a 30-year-old roof. It's 10 years old, 30% depreciation. It looks like it's 30% depreciated. It smells like it's 30% depreciated. That's the depreciation. And we don't say we're only going to depreciate the labor on that roof install. So I think that's where the big break is. Now, in the example of the modular home or the manufactured home, um, I think I would agree that the shipping to get the stuff to the site, possibly even the crane expense to lift everything. But when you start getting into carpet installation, painting, finishing up the roof and stuff like that, I think that gets more into the category of items that are a more component based thing that you can depreciate those things, and you're not going to break out the labor for them. So that's my take on it.
I don't think we will ever convince each other in like our hour-long conversations, because my next thing is, how in the world do you depreciate sales tax? Hi, knock, 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 New York, I'm gonna not pay you the whole thing right now. I'm gonna pay you 100% less 30% because that's what my insurance company paid me.
Well, in New York, we have you don't get charged sales tax for capital improvement, and most of the
Don't start
repairs that
with
you'll
me,
do.
Bill. You know what I'm asking.
Well, I this really has not been an issue in my career.
Yeah.
It's actually surprising to see that someone's going through the effort of class action lawsuit here, because in a
You're
practical manner, when you're looking at, let's say you've got your kitchen example,
mm,
and let's say I write a $60,000 estimate replacement cost to replace that kitchen,
right.
and I worked out all my depreciation numbers the way I do it,
Hmm.
not the way Chantal does it. And I come up with an ACV of, let's say, $45,000.
Okay.
We write the check to the insured for $45,000 less the deductible. And I tell them, look, when the work's done, let us know, and we will give you a check for the difference,
Hmm.
because that's what you're entitled to under the replacement cost coverage. But you have to make the repairs first.
Right.
And they're going to say, okay, but I have your $45,000, but I don't have an extra $15,000 to pay the contractor.
Right.
I say, that's not a problem. We can work that out. As you're getting closer to the job, just let me come to the finishing the job. just let me come out and do a final inspection as you're getting close, but make sure it's before he's completely done so that we know that there's just a few more things to be done. And then once he gets that final fixture in place, send me a picture and we'll get the balance to you as quickly as we can so that you can pay your contractor the balance. That's a really reasonable way to do it. I've never had anybody
Yes.
give me any grief about that. And some version of that is usually what takes place, whether you have a total loss. I mean, I've seen total loss claims where they issue the ACV payment up front, and then they issue draws for different phases
Yes.
of the construction. And
I
that's,
love that thing,
yeah,
really.
and that's
I
often
do.
orchestrated by the mortgage company who
Mhm.
is very, familiar with these cases and how the coverages work. And there really isn't that much of a dispute over whether we're depreciating labor or even overhead and profit in those scenarios, because if you enter it with fairness in mind,
Sure.
and the fact that you're gonna make good with the policy, then these arguments about, well, labor is not in the contract so you shouldn't depreciate, don't even matter, because what if you have a replacement cost policy, at the end of the day you're paying it all anyway.
See, but that's the point though, is I think the carriers are falling back on that. Here's the problem. I mean, yes, the way that you just explained how to settle a claim is the way that I settle a claim. But let's look at, and unfortunately, we don't have um, an Xactimate thing pulled up, you know, to a fake
I
Xactimate to
I
pull
could, but I
up.
don't have a fake one.
Yeah, I know. We should have pre-planned this better. So because at that last page, it'll say, total damages or, whatever, 60,000, less depreciation, 15,000, for an ACV of 45. But then you have added on to that like overhead and profit 10 and 10, and then you have sales tax or whatever. And so you end up being like, let's say 48. Okay. And what we have then is you are taking that 48 and then knocking it back down because you're depreciating overhead profit and sales tax and labor. So you're not getting the full like 48, which is the 45 plus tax or whatever, to leave the 15. You're really giving them like 43 when they need 48 to
Right.
even begin repairs.
Part of the problem, it kind of is a platform like Xactimate,
Yeah,
because
yeah,
in an effort to be transparent about all of the costs, it suddenly leads to discussions about these what
line items.
really amount to be minute details. Um, because if a contractor submits just a handwritten estimate, replace kitchen $45,000,
Right.
you're going to say, well, we're glad to pay it, but we have to depreciate it. So what do you think? 30%? Sure. The contractor's not going to say, well, are you depreciating all my labor? Because I really just want you to depreciate the materials on this job, not
Mm.
my labor. So then you're going to have to go back to him and say, well, you didn't tell us what the difference is. We can have that discussion, I guess. Or do you want to get started? Because we got a check right here. And as soon as you're done, you'll get the replacement costs. Like, what do you want to do?
You're right. You are absolutely right. Because if I got the handwritten note, I would tell them to break it out into, line item estimate. But B, yeah, I would just say 30% or whatever. And then you would go, aha, Chantel, you are depreciating labor. Well, I could also argue, aha, Bill, I am only depreciating, materials, because prove that I'm depreciating labor.
Yeah,
So
you
you
can.
are correct in the fact that Xactimate has kind of exacerbated this. Let's just blame Xactimate and call the whole thing off,
Oh
shall
yeah, Simsol,
we? Yeah, all of them.
Marshall Swift, Beck, all of them.
All of them. Let's just call the whole thing off. Okay. So what else do we have to discuss and argue about, cuss and discuss and argue about?
Oh, I don't know. I feel like we've come to an agreement.
I think we only have two. And let's see here. Next 2 weeks, like not next week, but the next time that we broadcast or whatever, we will be talking about determining liability. And also, it is mentioned here in Once Upon a Claim Fairy Tales to Protect Your Assets, which you can pre-order on all of your favorite pre-ordering book places like Amazon or your indie bookstore or Barnes and
Yes.
Noble or whatever. By the way, we will have an audiobook. So
Oh,
that'll be
cool.
fun. Yeah.
Yeah.
Anywho, yeah,
And I would
determining liability.
suggest that you buy as many as you can for your friends and,
Yes. Yeah, because what we do here in Once Upon a Claim, Fairy Tales to Protect Your Assets is explain the insurance and the claims situation. So want to know what your adjuster is doing? This is it. And if
this
you
is
are
it.
an adjuster, you need to buy the Art of Adjusting. So
Yeah, I could see a copy of that in every lunchroom of every insurance company just so that
I
they
would
have something to
love
talk
that.
about.
Actually, I want that on every adjuster's desk, so it
There you
gives me
go.
more money.
There you go.
Not just the lunchroom, because that's only one book.
Yeah.
But yeah, anywho, yeah. So determining liability and that kind of stuff. I think that'll be a lot of fun. Yeah, because I mean that's
Yeah.
really up your alley. So I'll probably be
Yeah.
asking you a lot of questions.
Yeah. And the science behind it.
Yeah, quote unquote,
Yeah.
air quotes. Yeah. Okay. Well, cool.
Cool.
Well, I will see you in like 2 weeks, I guess.
Yes.
All
All
right.
right. Take care.
Bye.
Thanks for joining us on the Art of Adjusting podcast, where we talk about life as an insurance adjuster.
If you enjoyed this podcast or this episode, please give us 5 stars and a review. It does help the algorithm pick us up.
Hit that subscribe button real quick and tell all of your adjuster friends to check this out as well. For independent adjusting services, go to www.auten.claims. And for anyone interested in working as an independent liability adjuster, go to the Contact Us tab to join our roster.
In the meantime, you can contact me at theartofadjusting.com for consulting and training purposes.